Harrison, let's talk about mortgage rates hit a new low in 2025. What does that mean for us?
They did. So as of Friday, they've reached the lowest point this year for 2025, and it's the lowest point since last October. So all of 2025 so far, 30-year mortgage rates have hovered between 6.5% to 7% for primary borrowers. And as of Friday, they touched 6.29. So a little bit of a decline. A lot of that is because of the employment numbers that came out on Friday, and now with the pretty much guaranteed expectation that cuts are going to be made from the Fed in September. So there might be a little bit of a window here for buyers, but especially people who have mortgages to look at taking advantage of this and be able to refinance.
And before you come out, I don't know if Chase were talking on air or off air about the mortgage brokers not being busy, but you talked about the refi a lot, which I'm kind of surprised on. And one thing that still worries me, I mean, the Fed cuts short-term rates, and I think right now there's just in sympathy that rates are falling the long end. But when we start, and again, when's a budget come up or the debt ceiling? I think it's October.
It's soon.
It's soon.
Yeah.
I think that's going to be a problem for the 10-year Treasury because it's going to come out like, well, we need more money. We need more money. And that pushes up the long end. So there may be a small window of opportunity to refinance here.
Definitely, because, rates don't just consistently go down, in a straight line. When you look at last year in 2024, there were 3 rate cuts, September, November, and December from the Fed. But the lowest mortgage point was early October, right after the first cut. So even though the Fed cut rates 2 more times throughout the end of the year, mortgage rates started to increase. So there's not a direct relationship between what the Fed does and mortgage rates. So this really might be a window. We'll see what the Fed does the rest of the year. We'll see what happens with the budget, but also this might be a window. I don't think that we're at a low point over the next several years. So I don't think we're at a point where it makes sense to pay points or pay extra to buy down the rate. But if you have a mortgage right now that's in the mid to high 6s to 7 or above, this might be something you want to take advantage of.
And I was going to say too, one thing that kind of gets forgotten about is, we talk about the 10-year. I don't think the Fed would go ahead and do this. We talked a lot about them cutting rates, but, re-implementing quantitative easing.
Right.
That would be, I think, foolish in my mind, because what that is essentially, that's the Fed now stepping in and buying more treasuries, buying more mortgage-backed securities, and that in theory is going to create demand for those issuances, which would then in theory push rates lower. I don't think they need to do that at this point, and I think that would cause longer-term problems, but just again, that could be something if they start announcing quantitative easing to help push rates lower. It's something that's maybe on the table with this push for a softer Fed.
That's part of the reason why also, like in 2020 and 2021, why mortgage rates got so low. The Fed was aggressively buying mortgage-backed securities and mortgages, and they had all the demand. And so, you saw 2% interest rates on 30-year mortgages. So that was such an unusual time. We're not going to get back to that. But now, being in the low 6% range is a pretty good place to be, short term. I think, next year, the year after, there's probably going to be more opportunities to refinance into lower rates. But this is something that probably borrowers want to take advantage of.
And, Chase, you brought up the Fed. One thing I'm not seeing in a while, I think they're still letting the bonds fall off the balance sheet. Last time I knew, it went from like $9 trillion, I think, down to $6 trillion. I don't know where it is now. I don't hear about that any longer. But that's a thing as well that's kind of helpful where the Fed stands. And we should look into that if you're not doing that right now, I think.
Let's see. It says, this is from 2023.
Yeah.
Let's see. Yeah, I don't have it off the top of my head.
Well, we should look into that. Just because I think it could be around $5 trillion, which would be, it could be good, but then you're right. They might say, oh, well, let's start easing again and raise that debt up, which we don't want them to do.
So anyway, rates at a good point right now. They've kind of consistently been coming down, but if you're someone who's been on the fence about looking at trying to refinance, if you've gotten a loan, whether you bought a house or you refinanced within the last 2 years, this might be a good time to see if you can drop that rate a little bit more.
And I just want to reemphasize too what you said too is don't pay points.
Don't pay points. Don't pay points, because for the last several years, whenever I've looked at the break even, when it's worth paying points, it only makes sense to do that if you're going to have that specific mortgage for 4-ish years or so.
Right.
3 to 5 years is the window. So what that means is if you think you're going to have the opportunity to refinance into a lower rate sometime in the next 4 years, which I think that is likely, you don't want to pay points. So try to refinance, get a lower rate than what you currently have, but don't pay extra to get that lower rate. Even if that means, because mortgage brokers always like to say that, well, I can get you into the 5s. Well, you're paying for that. Don't pay for that. Sometimes it's better to take the higher rate, don't pay any points, and then just look at refinancing again in another year or two or whatever it is.
Is there a rule of thumb on when to refinance? How much rates have to drop before you?
The rule of thumb is like 0.5% or 75 basis points of a cut, but I don't look at it that way, because the way I look at it is I've refinanced my own personal mortgage like 4 times, and every time I do it, I only reduce it by like 1/4 of a point or even 1/8 of a point. But when I do that, it doesn't cost me anything. So it costs me nothing to originate that new loan, and I'm dropping the rate. So that makes sense. Now, it doesn't make sense if I was paying $10,000 to drop it 1/8 of a percent. So you have to look at what is the rate declining, but also what is the cost that it takes to get that lower rate. So don't pay extra to get that lower rate. There's probably going to be more time in the future to get that lower.
Yeah.
Just to drive home this point on the Fed, I was kind of looking up while you guys were chatting there, but
I can see you over there working. I can see.
So currently the balance sheet is about 6.6 trillion.
Ooh.
It did near about 9 trillion. But what happened, and this is amazing to me, this didn't make big news, is the treasuries had a roll off of, I think it was like 35 billion. That slowed down to 5 billion a month. So that has really cut the pace of how much that balance sheet was shrinking. Actually, it went from 25 billion to 5 billion as a monthly cap on the treasuries. And then this is interesting. Mortgage-backed securities remain steady at a $35 billion limit. So that might be one reason why we've seen such a wide difference between the 10-year treasury and mortgages, is because they've allowed treasuries to run off now less than mortgage-backed securities. And again, this didn't make big news. This is way more important than a Fed rate cut.
It's
in my
important,
mind.
but that is probably harder to understand than the Fed is cutting rates. I mean, everyone, you can wrap your mind around that, but letting runoff happens of different types of debt is a little bit difficult for people to kind of.
And I was surprised on the slowdown of runoff. That's what, because I thought it'd be like 5 trillion. Because they had a pretty big pace of a runoff, and you said it's only 5 billion.
Yeah, so I mean, I guess in theory, it'd still be in about 40 billion if they were hitting the monthly cap every month. But before it was 25 plus 35. Yes, I mean you were at
60,
70 billion.
Yeah, you could do almost $1 trillion a year.
Yeah,
but that's slowed down. Then that's why they're not talking about it.
Yeah.
Well, Harrison, thank you very much for joining us. Great information on refinancing. And again, do not pay points.
Don't pay points. Yeah, no.
Thank you very much. Again, that's Harrison Johnson. He is our financial planner. He is a CFP. If you want a free consultation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Send an email. You get a free consultation. And again, he's a fee-based planner. He's not going to try to sell you annuities or life insurance. Compare what you have now to what he does. You'll be very surprised. All right.